Over the last few decades, there's been significant debate about whether dividends actually matter, and apparently Mirko doesn't believe dividends matter. He says all dividend theory is nonsense. It is more expensive to pay a dividend than if the stock increased the same amount. Dividends are tax negative due to withholding tax. If a stock pays 100% dividend or you sell it, it is the same. Just on the dividend, the tax is much, much higher. Dividends make no sense and is a topic for newbies. So, are dividends relevant? And is it possible, as Mirko suggests, that some dividend payments could actually be harmful? In this video, we're going to talk about it.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
This video is sponsored by you. Thank you to everyone that's currently supporting me on Patreon and via YouTube Premium. Supporters get access to ad-free and early content, as well as a monthly Q&A, access to any beta courses that I'm developing, and then ultimately discounts to those courses once they become available to the public. If you're interested in signing up, you can do so in the links in the description. So thanks again to all the supporters for helping make this content more accessible to more people. First, let's look at the argument of dividend investors. In the 1940s, a gentleman named John Burr Williams graduated from Harvard University. His thesis, which was eventually published into a book, basically argued that one of the reasons why the Great Depression occurred was because stocks were so volatile. It exacerbated the actual recession. So he argued that there should be a way for all businesses to be valued, and that coming to an agreed upon way to value stocks would contribute to less volatility and therefore less extreme economic recessions. Williams argued against using earnings to value stocks and instead to focus on the dividends that they either paid today or would pay in the future. Essentially, the value of any stock today is the current value of all dividends that it would pay in the future, discounted back at some rate of return. Today, we call that the dividend discount model. While some would argue that only valuing a stock based on its dividends is a bit extreme, I think if you take it to its logical end, Williams was absolutely correct. To illustrate, let's use this YouTube channel as an example. What is the value of my YouTube channel? Well, to find out, we need to know what the YouTube channel is earning. So far this year, I've made about $3,200 in AdSense revenue, and if we just divide that by the number of months, it comes out to about $400 per year. Per month. And if we just multiply that by 12, we can estimate that this YouTube channel generates about $4,800 per year. So with these $4,800 earnings, I have a decision to make. Either one, I can reinvest those earnings back into the business. Maybe I'll buy new camera gear, or maybe I'll subscribe to more research sources, or basically try to make my videos better and better and better, adding to my future YouTube AdSense revenue and any other courses I would sell or whatever comes down the road. I would reinvest in the business with the hopes of making a bigger future profit. The other option would be I could pay myself a dividend, or basically just take the $4,800 or part of it out of the business and pay myself to use on, whatever I wanted to spend the money on, or invest in stocks or something like that. So let's say I decide to take the route of reinvesting back into the business. So my $4,800 for the year, I reinvest that into buying a new camera. And the idea here would be this camera produces better videos, and therefore my earnings would go up. Maybe they go up to $6,000 the year after that. And let's say I also reinvest this $6,000, and this time I get a new research subscription or something, give more helpful research tidbits to you. So that again goes up to say $9,000. So all these reinvestments are adding to my earnings. But let's say I never actually pay myself any dividends this entire time. All I do is reinvest more and more money. And let's also say that at some point in the future, my YouTube ad revenue is going to be $0. So people stop watching this channel, or YouTube goes under, or something bad happens. So I end up making $0, say, in 10 years. What would be the current value of this YouTube channel if that scenario were to come true? If I never actually took any money out of the business, this business would basically be worthless. In the end, the only way I would get any money out of this channel is if I were to pay myself a dividend in some way, shape, or form. So you could say that, well, Nathan, you're going to have this fancy camera, maybe a computer, right? Like a laptop or something that I could sell, which is true. But the only way, again, I'm going to take any value from this business is if I, sell these items and pay myself a dividend. If over the course of a 10 or 20 year period, a company never pays a dividend and then the stock goes to zero, the total lifetime total earnings of all investors in that particular business would be $0. There's no other way that it could be anything more than $0. Now, some investors will make a profit. So maybe someone sold some of their stock along the way. Maybe they sold it at a record high or whatever. Those investors could make a profit. But collectively, as a whole, the investors in that business would earn $0. Some would earn positive, some would earn negative, but as a whole, nobody would make any money. If you disagree with me, please explain to me in the comments how it would be any different from that. Now let's take a look at the argument for the dividend irrelevance crowd. The dividend irrelevance crowd says that the dividend payments themselves are irrelevant. And on the day of the dividend payment, that is actually correct. Again, if we think about it logically, it has to be true. To illustrate, let's go back to my $4,800 per year YouTube channel. Let's try to value this channel, right? So let's say this $4,800 is basically going to continue indefinitely. It's not going to grow at all, but it's also not going to shrink. So it has a 0% growth rate. Let's say this discount rate is 10%, meaning you want to earn a 10% return on your investment. If that's the case, then this YouTube channel would be valued at $48,000. The other part of the equation would be any assets or cash that I would have. So I've got about a $5,000 camera and lens set up, plus I have about $500 in cash in the business checking account. So if we add those assets as well, we can calculate that my YouTube channel is worth about $53,500 as it stands today. Now let's say tomorrow I decide that I want to take out that $500 in the business checking account and pay myself a dividend, i.e. transfer the $500 from my business account to my personal checking account. So I move $500 from the business to me and my family, right? So we now have this $500 in our account, and the business now has $500 less. So if we subtract the $500 dividend payment from the value of the business, which we would do, now the new value of the business is just $53,000. So on the day of the dividend payment, my personal net worth went up by $500. However, the value of the business went down by $500. Hence, the total change in my net worth on this day is $0. A stock is no different. It's a publicly traded company. So if Apple transfers $100 billion from their, Apple checking account and pays that out to all investors based on however many shares they own, the collective difference in the net worth change of Apple shareholders as a whole is $0. Apple is going to be worth $100 billion less since that left the cash account, and the investors as a whole are going to get $100 billion more. So it basically just offsets itself. But it's important to distinguish between the relevance of a dividend payment on the day it's paid, which I agree is $0, it's irrelevant, but dividend policies are far from irrelevant. Whether a business pays a dividend or not makes a massive difference in the future value of the company. So once again, let's go back to the YouTube channel, and we're going to say in one scenario we have the dividend payment In the other scenario, let's say I were to take this same $500 and I would reinvest it back into the business, basically paying no dividend at all. Starting with the second example, let's say that this $500 would go towards hiring my first employee, maybe a part-time video editor. So this person's going to edit all my videos and basically allow me to earn even more in the future because I can now make more than just one video a week. So one video turns to two, which theoretically should increase my future revenue. Let's say it does. Let's say I go from $4,800 a year in AdSense revenue and I double that. So now I earn $9,600 per year. My ongoing income is going to go up by $4,800 per year because of this $500 investment. The return on investment there would be about 1,000%. Now let's say, on the other hand, I do not reinvest this $500 and instead I use it to pay myself a dividend. And with this dividend, I decide to put it into my M1 coffee can portfolio, which you can follow along with if you'd like. And let's say that this portfolio does basically the impossible, right? So it matches the same return that it got from May of 2020 to 2022. Which was about, we'll call it 25% annualized. Of course, this is not going to happen because this was kind of during the COVID lows, so we're not going to make 25% a year on it, probably nowhere remotely close to that, but let's just say we do. Would I be better off to reinvest the money or pay myself a dividend? Well, clearly, the reinvestment is better here. If I invested this $500 dividend at a 25% rate of return, this $500 would basically produce a $125 stream of income each and every year. And of course, I could reinvest these. So this would compound a bit, but so would this. So in this case, paying a dividend was actually harmful to my long-term net worth. I'd be far better off to reinvest the dividends. So on the day the dividend is paid, it is irrelevant. But the day after, it starts to make a difference. And over the next 10 years, it makes a substantial difference whether the policy of the company is to pay a dividend today or reinvest that amount of money back into their business. So when does it make sense for a business to pay a dividend and when does it make sense for them not to? It all comes down to how much of a return that company could get on their investment. And it also depends on the opportunity to get that return. So let's say on the left here, we have return on invested capital or return on equity. In my case, it would be the same since my business had no debt. So this tells us if I were to invest this $500, what return would I get on that? So if we draw this into a quadrant here, we have high return on equity here, and also high opportunity, meaning that there's lots of opportunities for me to earn this high return on equity. This would be like in my example with the 1,000% return on hiring the editor, for example. I had the opportunity to make a big difference in my business by hiring an editor, and that resulted in an extremely high return on equity. In this quadrant, let's say we have a high return on equity. However, we also have low opportunity. So this is probably an example that fits a company like Apple, for example. So Apple has a massively high return on equity. However, they also have a low opportunity to reinvest that money at those returns. The market is already pretty heavily saturated with their products, so they can reinvest that to some limited degree, but they're already so huge that the majority of their money is simply returned to shareholders in the form of dividends and buybacks. So companies like this should absolutely be paying huge dividends, special dividends, and if they think their business is undervalued, then buying back their shares. The company on the left, however, my YouTube example, this would be best to pay no dividends and reinvest 100%. There are some businesses that may look like they're high return on equity and high investment opportunity options, but ultimately may not be able to sustain that. One business that comes to mind for me is Netflix. they've been continually reinvesting back into their business to create more and more content. So if you look at their free cash flow statement, they haven't actually generated much, if any, positive free cash flow. All the money they've been earning, which is a substantial amount, has been going back into the business. That makes the product better and better and better. However, if that is basically a hamster wheel that they have to continually ride forever, always adding new content, what's going to happen is it's going to be extremely valuable for consumers. We're getting unlimited content, for less than $20 a month, which is extremely valuable. But shareholders of Netflix, again, will never, as a whole, make a positive return on the investment unless Netflix at some point in the future pays a dividend. In this bottom quadrant, we have a company with a low return on equity and also high opportunity to invest it. So this might be a business like Ford, for example. So Ford earns an incredibly low return on equity. So if they were to invest at a 5% return on equity, that is extremely bad for investors. We do not want this company to reinvest on our behalf. We do not want them opening new factories. We basically, again, want them to pay a huge dividend, which Ford does. That's the optimal capital allocation for them. And then you have another business with low return on equity and low opportunity to invest. And again, a company like this should also be paying a huge dividend for whatever they earn, paying that back to their shareholders. That is optimal. But in this situation, the best company to invest in is going to be the high return on equity and high opportunity. These are the businesses that are truly going to make you extravagantly wealthy over your lifetime. If you look back at many of Berkshire Hathaway's best investments, the most classic probably being See's Candy, you'll find that they were able to earn extremely high returns on equity or capital, and they also had a significant opportunities to expand and invest at those rates. However, these businesses are few and far between. Most of the businesses, specifically the dividend aristocrats and companies like that, are going to fall more into this realm. Basically, cash cows that earn a really high return on equity or capital, but they don't have a ton of opportunity to expand those. So no matter whether you decide to invest only in dividend companies or only in non-dividend paying companies, it's most important to determine the capital allocation policies of the particular business you're looking at. Are they making an intelligent use of the capital that they're reinvesting? Or are they reinvesting that money at ultimately extremely low returns for shareholders? If that's the case, then the company is doing a bad job of allocating capital. Conversely, a company with a huge return on capital and a big opportunity to expand the business is actually hurting shareholders by paying a dividend. So let me know in the comment section whether you agree or disagree. I'm sure there'll be a lot of interesting discussion and debate. If there are any comments that I feel like are inappropriate or just rude or mean or whatever, I will delete them and remove you from the channel. So rather than leaving a rude comment, don't waste your time. Just go ahead and click the unsubscribe button and leave us all alone. I'm trying to build a community of like-minded investors that will encourage one another to make better investment decisions, and rude, negative comments will not be tolerated. So thank you for adhering to that policy. Again, that's not saying you have to agree. Certainly do not. Please disagree. If you disagree, just do so with some tact and kindness to your fellow man. So thank you again for watching the video.